Hello, everyone. Welcome to our analyst call. Welcome. I'll let everybody join and then we can get started. How are you guys doing?
Doing great, doing great. I think that's a special edition, right? After our massive publications, I think that's going to be a very special edition this time.
It's a special occasion today, indeed. Very special one. Welcome, everybody. Let's get started in about a minute. Great. It's getting populated. Love it. All right, let's get started. Thank you, everyone, for joining our analyst call. My name is 𝕂𝕂𝕠𝕕𝕖 from 21Shares. Today is a special session with our research team, our wonderful research team. We have Adrian, we have Carlos, we have Lina, we have Kareem. Today, we are very excited to show you guys our recent publications. This is the world's first multi-dimensional standard classification for this asset class. So Carlos is going to present some of the slides and some of our findings to finally have a consensus in our industry on how to classify these crypto assets. The whole vision came from the fact that there is a lack of consensus in this asset class, that we have different data platforms having their own classification, not agreed upon by the overarching definitions of different assets, and also how these different assets reflects the regulatory evolvements and ramifications. So we're super, super proud to present this wonderful classification that we partnered with CoinGecko. For those who don't know CoinGecko is the world's largest price tracker and aggregator in this space, with about 30 million visitors on a monthly basis on their websites. So every time people want to discover crypto assets and their prices and movements in liquidity or volume, usually CoinGecko is a place to be. So we're very excited about these partnerships, and most importantly, Carlos, the floor is yours.
Thank you, Ellie. I will share my screen now to present. Let me know once you can see, please.
We are about to see it.
Yes,
Great.
all good.
Okay, so as Ellie said, it's our pleasure to present the global crypto classification standard that we developed jointly with CoinGecko. So first of all, why is there a need for a global crypto classification standard? As Ellie mentioned, crypto still has many misconceptions. And you can see this by the fact that still many people use the term cryptocurrency, which in reality is a misnomer because crypto assets can vary dramatically in nature, both as it relates to the asset or the token itself and the protocol that issues that token behind it. So to help investors, whether they come from a traditional background or they come from a more crypto native background, navigate this asset class more easily, we proposed 3 levels of categorization to provide a standard classification for this industry. So in the first 2 levels of the classification, we only refer to the protocols or the networks behind the projects instead of the underlying crypto asset or token. So what I mean by this is that in the first 2 levels, I will refer to Ethereum, the network, instead of Ether, the asset. Or I will refer to MakerDAO, the DApp, instead of MKR, the governance token, and so on and so forth.
And maybe Carlos here, you can clarify what's a DApp. So most importantly, what we want to do here is avoid using their crypto jargon, because we want to make sure that we speak in the language of traditional finance investors. So DApp stands for decentralized application. We can just refer to them as applications because we know already that they are built on a decentralized infrastructure like Ethereum or Avalanche or Solana. But yeah, please go ahead.
Exactly. If this all sounds a bit confusing right now, don't worry, because we are going to get into each of these levels individually to explain it further. But just to summarize a bit before we dive in, level 1, which is the crypto stack, refers to the various layers that compose the crypto universe. This is a level that may be foreign to many traditional investors, so we want to make it as easy and accessible as possible. Level 2 refers to market mapping by sectors and industries, as it was introduced by the S&P in 1999 and is used by the global financial community today. So this is the level that most traditional investors will be familiar with, and it's the most easily accessible level, in my opinion. And then level 3, we move on from the networks or the protocols, and we refer to the crypto assets or the tokens themselves. And here, we not only try to distinguish between each type of crypto asset that exists, but we also try to classify it according to the asset superclass to which they belong. So let's dive into each level individually. So first of all, you can see the crypto stack refers to the protocols that compose crypto's infrastructure, similar to how software applications are part of a larger tech stack. So here we have, for example, cryptocurrencies, which are essentially crypto assets that are specialized in value transfer. So they fulfill the role of money, or digital commodities. Think digital gold, for example. We also have app-specific blockchains, which are blockchains built for one specific function, such as Filecoin and 𝕂𝕠𝕕𝕖𝕂, which are built specifically for data storage. We also have centralized applications, or CApps, which are mobile applications that are linked to centralized entities such as Coinbase or OpenSea. So the key characteristic of centralized applications is that either users interact with them in a custodial fashion, or that the entities behind them maintain the right to blacklist accounts. We also have interoperability protocols, which are blockchains designed for inter-blockchain communication. So one characteristic of blockchains is that they are isolated from the world outside their ledger. So what these protocols do is that they allow blockchains to communicate with each other. We also have oracles, which are any data source for reporting information external to the blockchain, such as price feeds or the weather, such as Chainlink and 𝕂𝕂. We have decentralized applications, which are web and mobile applications to access crypto products and services, similar to CApps, but in this case, they are completely decentralized, so users interact with them in a non-custodial fashion. We finally have smart contract platforms, which are blockchains with built-in general purpose programmability that allow developers to launch decentralized applications. And we also have scaling protocols on top of them that help scale these smart contract platforms by orders of magnitude. So to explain this a little bit better, we actually conducted an analogy between the crypto stack and physical world analogies so that it's very easy to understand. So I want to start by smart contract platforms. So smart contract platforms, you can think of them as digital nations or cities, because each of them has its own native currency that drives economic activity in that nation or in that city. On top of smart contract platforms, you have scaling protocols. Scaling protocols are like skyscrapers because they remove the congestion in the nation or the city on top of which they are built. So as you can see, scaling protocols help scale smart contract platforms because they remove the congestion from the base layer, similar to how a skyscraper removes the congestion in a city. Below smart contract platforms, you have interoperability protocols. These serve as shipping routes because they help smart contract platforms interact or connect with one another. For example, Ethereum doesn't normally interact with Solana. It's impossible for them to do it on their own. But with interoperability protocols, they can connect with each other. So there are like highways or shipping routes that helps connect these various digital cities. Then on top of this infrastructure layer, we have app-specific blockchains, we have dApps, and we have CApps. These are the products and services in the crypto economy with which users interact with. Notice that from the user standpoint, it doesn't really make a difference what type of structure it has. It doesn't matter if it's an app-specific blockchain, if it's a dApp or a CApp, they will interact with it as if it is a software application. But in reality, the structure is a bit different, as I explained earlier on. Here, most dApps, what I would want to mention is that they are organized as decentralized autonomous organizations, which are basically internet native businesses. Another important thing here, and a very key piece of infrastructure, as you can see on the left side of the diagram, are oracles, which provide data from the physical world, like weather or traditional asset price feeds. This is very important because otherwise the utility of smart contract platforms will be self-contained. It will be a self-contained system. So oracles are a very critical piece of infrastructure. And finally, to your top right corner, we have cryptocurrencies, which are basically like commodities such as gold. So I hope that this helps you understand a little bit better the various layers that make up the crypto stack. So here we can move on to level 2, which is market mapping by sectors. Just for reference, sector will refer to a large segment of the crypto economy, while the term industry will refer to a much more specific group of companies or businesses. Here again, we're referring to the networks or protocols themselves, not the tokens associated with these protocols. Very important to remind ourselves of that. So here you can see a map of all the sectors that we find in the crypto universe or the crypto economy and the various industries within those sectors. So you have application development, you have centralized finance, you have metaverse, you have decentralized finance. I won't go into each of them individually, but what I would want to mention is that decentralized finance is clearly the most developed sector as of right now. And for example, in decentralized finance, you can find many primitives or industries such as credit and lending. You can find decentralized exchanges, you can find derivative marketplaces, and so on. Ellie, do you want to add anything here?
No, absolutely. The key thing to remember here when you look at the different levels from level 1 to level 2, which is now level 2, is that we applied the traditional sectors and industry to the crypto asset economy, which basically means that cryptocurrencies is a misnomer and not all the crypto assets are equally the same or serve the same investment case. As you can see here, from metaverse, decentralized finance, to even like entertainment and leisure, identity. There are various blockchains, even at the infrastructure layer, that really serve some specific use cases, like, for example, storage of information, storage of data, like 𝕂𝕂, right? And then we also have specialized blockchains to provide a tunnel between traditional finance data, like prices and the weather, to basically the blockchain economy. Because of the lack of parameters of traditional blockchains like Bitcoin and Ethereum, they essentially need to have third-party vendors or blockchains to provide that information coming from external existing systems. So that's basically mapping essentially how traditional finance investors are looking at the software as a service industry or looking at essentially the equity market to make a better sense of whether they want to have a thematic-based strategy to invest in specific themes or just to make sense of how a specific company fits into a wider segment to evaluate them in a better way.
Exactly. And so finally, we can move on to level 3. Here, we won't talk about the protocols. We move on from the protocols and we start talking about the tokens or the crypto assets themselves. So here, we not only try to distinguish every type of token that exists, we also try to classify them according to the asset superclass to which they belong. So in his seminal paper, What is an Asset Class Anyway?, Robert Greer proposed 3 asset superclasses. I will go through each of them briefly, just because it will be easier to understand later. So a capital asset is the first asset superclass. This is an ongoing source of something of value. So in the traditional world, the classical example of a capital asset are equities or bonds, because they have an ongoing source of something of value. Then the second asset superclass are consumables and transformables. So you can consume it, you can transform it into another asset. It has economic value, but it does not yield an ongoing stream of value. You can think of this as commodities like grains or precious metals, because they can be consumed or transformed, but they do not have an ongoing yield or a stream of value. And then finally, you have store of value assets, which cannot be consumed, nor can they generate income, yet they do have value. The best example of these are currencies, like the dollar, for example. One distinction that I'll make, or one caveat that I'll make, is that some assets can fit into more than one asset superclass. So the best example of this is gold, because gold is a commodity, so it is a consumable or a transformable, but it is also a store of value asset. So with this in mind, we apply this to the taxonomy of crypto assets. So for example, in the top, the currencies like Bitcoin. Bitcoin actually resembles gold in that it is both a consumable or transformable because of its proof of work consensus mechanism. and it is also a store of value asset. Then you have also native currencies like ETH and AVAX. Native currencies by themselves are consumable assets because they actually serve as gas, basically, for users to interact with a smart contract platform. So when I interact with the Ethereum economy, I must pay a transaction fee in ETH every time I perform a transaction. So it is like a gas token. It is a consumable. Then we move on to stake currency. So the same as above, but from the standpoint of validators. So stake Ether or stake Sol. So in proof of stake networks, validators commit a portion of their crypto capital to be eligible to basically confirm transactions and secure the network. In return for doing that, they receive a constant stream of cash flows from the network. So a stake currency is basically a capital asset. We also have derivative tokens, which refers to other assets outside of the blockchain, such as solely we have tokenized stock, or you have wrapped Bitcoin. You also have governance tokens, which are at a DApp level. So for example, MakerDAO has the governance token MKR, Uniswap has the governance token Uni, Lido has the governance token LDO. So governance tokens are capital assets because they yield voting rights on the platform and they have potentially the right for a profit from the protocol. You also have utility tokens such as SNX, Link, or ZRX. The utility tokens enable the functioning as a platform. So they are more like consumable or transformables because they just allow you to interact and enable the functioning of a protocol. Then you have stablecoins. Most of you will be familiar with stablecoins, but basically stablecoins try to maintain price parity with a target asset, usually the US dollar. And we have three different types of stablecoins. So the first type of stablecoin is fiat collateralized stablecoins. So stablecoins like USDC and USDT will maintain an off-chain reserve of US dollars as backing to maintain the price parity. Then we have anchored stablecoins, which have exogenous collateral. DAI, which is from MakerDAO, is over collateralized by an amount of other crypto assets, such as ETH, for example. So notice that the governance token MKR, which is associated with Maker and DAI, does not play a role in backing of DAI. So it's an exogenous collateral. It's away from the system itself. Then you have reflexive stablecoins, which are partial or non-collateralized. The best example here was USD from Luna, which had a death spiral because it wasn't backed by anything at all. So it was a non-collateralized stablecoin, and this is the riskiest type of stablecoin. You will also know them as algorithmic stablecoins. And then finally, you have NFTs. Most people think of NFTs solely as collectibles, but actually NFTs are just a token standard and they can be used for a wide array of use cases. So the most popular one are collectible NFTs, such as CryptoPunks or Bored Apes. But we also have royalty generating NFTs, which yield ownership rights to song, videos, etc. These are very important for content creation. So for artists or musicians, so that they have a constant stream of cash flows from the art that they generate. And then finally, you have consumable or redeemable NFTs, which yield deeds to a car, tickets to an event, etc. So royalty NFTs will be capital assets, where consumable NFTs, as its name suggests, are consumable or transformable assets. And with that, we conclude the 3 levels of categorization of the global crypto classification standard. And just to summarize, the idea is that investors can use these 3 levels as pick and shovel tools to categorize crypto assets and the protocols behind them along these 3 levels in the most relevant category. Ellie, do you want to add?
Absolutely. Thank you so much, Carlos. Maybe let's go back to the first slide to show them again, the 3 levels, so that we have a clear summary of the levels that makes a lot of sense. So again, like to repeat, the level 1 is what is the crypto universe? Level 2 is how does the crypto universe have similar parallels with traditional finance and the equity market. And then most importantly, because most of these crypto platforms and networks do have tokens, then we have a level 3 to understand how they are fitting into the overall asset superclass. So maybe I have a question here for the audience, for Adrian and Lina and Karim. Let's start with Adrian first. How do you envision GCCS to be used, especially in traditional finance? Maybe Adrian, you can start here because you came from a very interesting client roadshow as well. Maybe I would love to hear your feedback here.
Why we started off with the entire project is definitely because there's not a real standard in crypto. Everybody has a different classification standard and a different methodology. And it would just be great if there's one standard that we can all agree on. This obviously also has a major impact on traditional finance because it not only provides education, it more importantly provides clarity, and clarity in a way that, for instance, for regulators, if they want to regulate this asset class, they need to understand how it's classified. So I think that's just an amazing base work that could help them lead to better regulations. Another example would be index providers. Obviously, we're working in the ETP business. In traditional finance, there's things like thematics or different sector-based ETFs. And obviously, when you want to work on something like this, you got to have a clear understanding, a clear classification of the underlying assets.
Yeah. Absolutely. Now, couldn't agree more. And especially when we're seeing the different type of classifications across the industry, which of course we're a tiny industry compared to the equity market, compared to, of course, fixed income. Lina, Karim, do you have any thoughts to add to that?
I don't think we want to add a lot more just to avoid being redundant, but I do think that one of the things that this really helps with is introducing clarity to the ever-expanding crypto universe. There is way too many assets and crypto tokens that are created and are built on a weekly basis. So for anyone who isn't really keeping tabs and is actively involved in the crypto space, it can become pretty much a nightmare in order to understand where do some of these assets fit. So yeah, that's really imposing a lot of order on the crypto universe, if you may.
Absolutely, couldn't agree more. So if we have any questions regarding the classification, feel free to shoot your questions in the Q&A section of this call. So the next up that we want to do here is discussing about generally what we're expecting going forward, especially in the event of what happened over the past month or so. We published our monthly review yesterday by our very own Lina and Karim. So check it out on our website, 21shares.com/research. You'll be able to find it. But let's start with the key insights from this month that would set the stage for the upcoming weeks. Maybe we can start with you, Lina, and then have a roundtable here.
Thanks, Ellie. Absolutely. The key defining moment for the past month was Paxos and what happened with BUSD in response to the crackdown that's been revisited on unregistered securities. So basically what happened with Paxos is that the U.S. regulators ordered them to halt BUSD, Binance USD, which is the third largest stablecoin after Tether and USDC. And after they ordered them to halt it, of course, they had to comply because of unregistered securities on Binance, which was also part of a crackdown on Binance with regards to AML problems and uncertainty. After that, what basically happened, and thanks to our Dune dashboard compiled by Tom, who is sadly not with us today, we found out that so many outflows happened from Binance to Coinbase, especially on USDC. Market cap has been dwindling, but the main winner of this rally was Tether, that on the night of the enforcement, about 720 million was added to the market cap of Tether. That's huge and quite expected. And that sort of gave way to some decentralized stablecoins and some coins that were in the runner-up on the ladder. Like, for example, Aave's GHO, which was just live on Ethereum testnet Gurley. Aave's native stablecoin is fully collateralized stablecoin, decentralized also stablecoin that is on the rise. That's something that we're monitoring closely and we're betting on, since there has been an exodus to decentralized finance and decentralized applications of crypto. Something else that happened was TrueUSD. Binance has been minting TrueUSD vigorously. In just a week, they minted $130 million worth of TrueUSD. He also implemented the Chainlink Proof of Reserves plugin, and that is also mainly to safeguard and ring fence their security and their stability in the eyes of regulators. TrueUSD, I want to also add that TrueUSD just became, on the back of the minting, just became the 5th largest stablecoin very recently. And on the back of the 6th largest by market cap called Frax, which was an algorithmic stablecoin, and it was on the rise and there was a lot of momentum about it. Frax, they shifted their mechanism to a fully collateralized stablecoin, still decentralized, but also they jump ship on the algorithmic mechanism. And that is also some sort of trend that we're seeing to comply with regulators and to safeguard the backing of the stablecoins. And that's something that we'll see in the ramifications of Paxos in the coming few months.
The TLDR for what you just said is that essentially we've seen the rise of fully collateralized stablecoins, especially the ones that had a past that was more questionable, like Tether. So we've seen the rise of Tether, especially on centralized venues compared to decentralized venues. On decentralized venues, as you can see on our dashboards, I'm going to share my screen again, USDC, so the second largest stablecoin in the market, is actually dominating. And you can see here with the market cap of USDC compared to USDT. As you can see here, 33% for USDT on the right-hand side of the charts, and about 42% of USDC over decentralized finance. But it's true when we're looking at the market cap of, especially the liquidity of USDT in centralized venues, like for example, Kraken and Coinbase, absolutely Tether is the leading market player in that regard. But again, like for the decentralized stablecoins with a plethora of collaterals and not just like full, real dollars in bank accounts, it's possible that they may raise in market share at some point. But it's going to be a very important space to keep an eye on. After this call, don't worry, you're going to receive our dashboard so that you can see in real time the evolution of the stablecoins vertical as well. Adrian, what were the key highlights for you and what are you expecting going forward?
I think I have 2 key highlights. I think what really stood out to me, as I'm a macro lover, but unfortunately were the inflation numbers in January. If we look at the US, the CPI numbers in January rose by 0.5%. or 6.4% year over year. If we look at the personal consumption expenditure index, the PCE, which is like the Fed's favorite inflation metric, it showed prices rising 4.7% over the last 12 months. All of this is way higher than people expected. And obviously, it doesn't set a good tone for the future monetary policy of the Federal Reserve. And on top of all that, the unemployment rate is still super, super low. It has remained, like, I think, close to a 50-year low. And an uptick in inflation is obviously the exact opposite of what the Fed wants to see. And in my opinion, going forward, this could definitely, keep rates higher for a longer time than the market actually has hoped for. And this ultimately will have a pressure on earnings. So I think inflation and the monetary policy will set the tone going forward. So we're closely watching that. But I'm sure the Fed is also aware that there's a limit of how much they can raise interest rates, because monetary policy can take up to 12 months or 18 months until we really see the impact of those interest rates. I think it's a narrow game that they're playing, but let's see how it plays out. But in terms of, 𝕃𝕚𝕚 mentioned regulatory crackdown, we see inflation coming in hot, but we're still up 40%. Bitcoin is still up 40% year to date, and that's definitely a surprise as well, in my opinion. It's quite nice to see.
And I think there's a silver lining to that performance as well.
Yes.
The rise from the lows. We've seen as well that Bitcoin has expanding emerging use cases. If you read our research over the past few years, we always said that Bitcoin is also a software, it's also a platform, a limited platform compared to Ethereum, not as expressive smart contracts as we see on Ethereum with decentralized finance and metaverse. But definitely here, Adrian, you can touch base on the emerging use cases that we see on Bitcoin today with NFTs like ordinals, and of course, and also stacks that provides a smart contract platforms, which basically also spurring the latest performance for Bitcoin, especially year to date.
Exactly. Yeah, that's my second point. I think Bitcoin surprised with additional use cases. Let's call it like that. And I think the best example is ordinals. So for our listeners who haven't heard about ordinals, it's a protocol on top of Bitcoin, which has been created by Casey Rodarmor. And basically each Bitcoin is broken into 100 million Satoshis. So it's like cents to the dollar. And this new ordinals protocol, it allows people to inscribe individual sets with additional data. And what people have been doing is basically creating NFTs on the Bitcoin blockchain. The thing is, I wouldn't even call it Bitcoin NFTs because there's a major difference between NFTs on Ethereum compared to Bitcoin. On Ethereum, NFTs are basically a string or a pointer to some off-chain data, which is stored on IPFS, for instance, a decentralized storage system. While on Bitcoin, the actual metadata is inscribed on the chain. So I think Rodarmor referred it as digital artifacts because the metadata plus everything is registered on top of Bitcoin. And I think that's super exciting. I know Bitcoin maxis that might be listening, Bitcoin has been really boring in its use case, which is good. Simplicity is good. But now we see this new excitement coming up with new use cases on top of the Bitcoin blockchain. You also mentioned stacks, Eli, which is another layer building on top of Bitcoin. And I think going forward, we will see a lot of excitement development on top of Bitcoin.
Yeah, we can see here all the NFTs built on top of Bitcoin from Gamma. Gamma is one of the largest marketplaces for NFTs on the Bitcoin network, actually built on stacks. And scrolling down, you can see here that we can check for ordinals. When you click on ordinals, we can basically inscribe essentially an image or an NFT directly on the Bitcoin network. So I can show you here, I can browse for an image, I can go on that specific image and essentially add the NFT or the image, so the metadata of that NFT onto the Bitcoin network, and then select a specific fee tier in order to basically accelerate the settlement of that data onto the Bitcoin network. So this is a 101 instruction into how to create an NFT on the Bitcoin network. There you go, guys. This is awesome. Carlos, tell us more about your key highlights for the month and what you're expecting going forward. Thank you, Adrian.
Sure. My key highlight is regarding macro, and it's supporting a little bit of what Adrian said earlier on. So if you look at the spread between the 10-year and the 2-year U.S. Treasury yield, so if you actually expand the chart for it to go further back in time to 1980, so if you look at the chart, you can see that the spread between the 10-year and the 2-year U.S. Treasury yield has reached its lowest level since September 1981. So this is very important because the deepened yield curve inversion basically is reflecting bonds investors' expectations of a decline in longer-term interest rates. And this has been a historical leading indicator of our recession. To add to this, there is also, as Adrian said, rising uncertainty regarding inflation, which also raises uncertainty about the actions that central banks around the world will take, such as the Fed, for example. And already this month, 2 Fed officials, the St. Louis Fed president and the Cleveland Fed president, had said that they would have preferred to see a hike of 50 basis points earlier this month, instead of the 25 basis points that we actually saw. What this tells us is that both the bond market and some Fed officials are signaling that rate increases are not over and that a 50 basis point hike is back on the table for March. I would say both for the Fed and for the European Central Bank. And so this is my highlight for this month.
Yeah, absolutely. But also, I think like on the back of what you just said, there is a minority agreement on a 50 basis point interest hike as well. I think we have yet to see, but it's a possibility. The possibility that I would give, in my humble opinion, would be about 20 to 30% upward to 40% chance of this happening compared to 25 basis point interest hikes. But again, we have yet to see how this is going to pan out. But I think the future inflationary pressure, we have yet to see whether the extending inflationary pressure is going to continue going forward, especially this year. Because when we look at the CPI numbers, these are backward-looking numbers looking at the past year or so compared to what we may expect going forward from unforeseen events that usually the macroeconomics are not indicating. So thank you, Carlos. I couldn't agree more with all of you for sure. Karim, do you have any closing thoughts on that?
Yes, definitely. Maybe not a follow-up on what Carlos just mentioned, but there is a very exciting narrative that is taking place within the DeFi. So essentially, from my view, the one key highlight of February has been asset tokenization. We have been, advocates of blockchain technology that we're not just in a race to find the highest yield, but more so finding a sustainable and a sustainable yield, have all been calling for the process of tokenization. So just for anyone who doesn't understand, tokenization simply refers to converting something of value into a digital representation that lives on the blockchain. That is, of course, like the process itself is excellent because it introduces so many benefits that we don't see in traditional finance. For instance, we have an advantage like atomic settlement. Rather than waiting for a few days for a transaction to be executed and processed fully, with blockchain, with the newer generation of blockchains, we are able to reduce this time down to a few minutes. So that is a huge breakthrough. Another thing would be reducing the cost of maintaining this entire process. As I will mention in the few examples that have emerged over February, most of the traditional companies or crypto native companies that are trying to bridge to TradFi, they are doing this on what we call alternative smart contract platforms. So they are essentially the twins and the cousins of Ethereum, but they serve the same functionality as Ethereum, but they do it in a more efficient manner and in a much faster manner.
Yep.
So yeah, this is just an overview of what tokenization brings to crypto. To follow up on that, for instance, we saw that Hamilton Lane is one of the largest investment companies in the world. They have almost, I think, up to 400 billion of assets under their supervision. They tokenized the first of a series of 3 funds. One of them is called Equity Opportunities, and essentially it is a digital bond that is worth 60 million euros. It has a maturity rate of 1 year, and the interest rate isn't really known. They were able to essentially issue this bond on a platform called Securitize. It's essentially a tokenization platform that lives on top of Polygon. And just moving forward, Polygon has really been taking the spotlight because it introduces and offers exactly what Ethereum offers, but in a much more efficient manner. So that was one example. We also saw Siemens. They also issued a digital bond on top of Polygon. We don't know much of the details about it because it just wasn't as widely well known, but we do know that they have issued it on the blockchain.
I think it's a good segue to the links that we're going to provide you guys to our monthly review written by 𝕋𝕚𝕖 and Karim, unpacking the industry, because as you guys know now from our classification that Carlos presented previously, we have a fast-growing industry with multiple sectors. So Karim and 𝕋𝕚𝕖 really broke down the key highlights and the key insights that you need to really remember going forward as we are basically monitoring the innovation and most importantly also the headwinds of this space. But tokenization is definitely one of the biggest, I would say, narratives from this year. And most importantly, the tokenization is really built on top of public blockchains compared to on top of ring fence or distributed ledger technologies built by basically a handful of developers. We're seeing that now people prefer the public infrastructure that is secure enough, decentralized, and most importantly, permissionless globally, like Ethereum, like Polygon, like Avalanche subnets. And I think there is a lot more technologies built on top of these blockchains, as you mentioned previously, Karim, with scaling solutions, with cybersecurity products to protect against hacks, that are going to be equally important as well to really have a seamless tokenization across different blockchains, across different platforms that are built on top of that. And that's why we're equally excited as well going forward for this year. So bear in mind that after this call, you're going to receive some links about our dashboards, about our monthly review, but also our latest magazines on what we're expecting from this year for the market outlook. So stay tuned for that.
Just want to double down on something that I found really interesting. HSBC, for instance, they also have their own tokenization platform. and I can't really remember the name of the company, but we will send this in the email afterwards. Even though they issued a bond on a private blockchain, they still maintain the record keeping on Ethereum, which speaks so much volume to the value proposition of public blockchains, the transparency, the auditability. So even though some of the largest banks are still using a private blockchain, I would say for the sake of privacy and confidentiality, they still are keeping a sort of a mirror or a proof that these transactions occurred on a public blockchain. This is really 180 degrees from how this industry was viewed a few years ago, when public blockchains were not the way to go. So yeah, it speaks volume about how the industry is evolving.
It does speak volume a lot, absolutely, especially despite what happened last year. And we keep seeing the innovation happening, and the growing developer community as well is second to none. As a matter of fact, as we speak, there is the If Then There conference, and that's really exciting because now we are seeing the FM community bringing together to really focus on the latest new technologies to make FM more secure, to make the ecosystem more robust. I think out of these conference, we're going to hear also some exciting projects that we haven't heard.
I think that's what people should always have in mind. I know crypto looks very flashy from the outside, but all we're trying to do is build infrastructure and a global standard for a settlement layer. And a global network is always stronger than a siloed internal distributed ledger. And I think big corporations starting to realize that as well. Obviously, they want to have some security, some compliance internally, but in the end, they got to be connected to a public blockchain to fully leverage the benefits.
And very analogous to how, all of these, I would say, dinosaur companies before the internet had to be integrated into the new infrastructure, into the World Wide Web, into TCP/IP, into HTTPS or HTTP, in order to make sure that they can actually have access to a wider community. And then the iPhone came out in 2007 and provided a new infrastructure again, basically have access to a wider audience where people actually don't have traditional mobile phones or even like traditional infrastructure for having access to financial services. But again, like thanks to a smartphone, like they have access to over services that are provided to them at their fingertips. And that's exactly what we're seeing with the new generation of innovation with technology after cloud computing, after mobile phones, after the internet. And that's a combination of everything that happened before that makes it possible to have access to that new infrastructure. It's a very glunky infrastructure at the moment, the same way the internet was before bandwidth, because it was just dial up. But this is really exciting for us, especially when we see that the adoption is touching people's real world use cases and real life as well.
Just to deliver a point on this very last statement, one of the other protocols that emerged in February was Swarm protocol, which essentially allows tokenized exposure to U.S. Treasury bills or U.S. Treasury bonds, as well as on-chain stocks. But I'm mentioning this specifically because I was discussing this amongst my friends. I was essentially asking, what is the process of how can we, as Egyptians, because I'm based here in Egypt, how easy is it, or how convenient is it to invest in U.S. Treasury bonds? Non-surprisingly, it's a very complicated process. So with the emergence of applications as such that do not require a minimum investment of $100,000, and it is a globally accessible solution that is available to anyone with an internet connection and a mobile device, this really addresses one of the worst inefficiencies of traditional finance. And it's really cool to see that there's a lot of benefits that can actually be extrapolated to your daily average Joe, that you don't have to be a professional accredited investor to leverage these solutions. It's democratizing the financial system to include as many people as possible.
Absolutely. And that's exactly what the ETF structure back in 1993 actually did to mutual funds. And actually now we're seeing that with tokens and globally accessible financial infrastructure. That's really amazing to see. All right. I want to thank you, everyone, especially you guys, Adrian, Carlos, Lina, and Karim, for making the time for this great conversation that we had today. And also to the audience, thank you for making the time and having us. You're going to receive the classification standard, the monthly review, the market outlook for 2023 via email after this call. If you have any questions, feel free to reach out to the research team via email. We're also available on social media, on LinkedIn, and also Twitter. But thank you so much, guys. Thank you, everyone.
Always.
Thank you.
Always a delight.
Thank you. Bye-bye.
Bye-bye.